Welcome back. We are busy with class 7, which is investments, and we are looking at unit 2.3 in this specific session where we will address equity markets. Now, first we need to understand the equity market or then a stock market. Equity, the word means ownership. With ownership comes the risk that you could lose every rand and even more. Why then should one consider investing in equities? The reason is simple. You can be surprised on the upside. A sound portfolio of equities can provide you with an income for life, which may even keep pace with inflation. Stock markets is both part of the primary market and the secondary market of the country. As part of the primary market, it's used to raise capital both as shares or as fixed interest bonds, as explained in our previous session. As part of the secondary market, it is used to trade the securities that have been issued. What is a share or an equity? Each share represents part ownership in a company. In return for investing capital in the company, shareholders are entitled to certain rights, and these rights may include specific and or a combination of the following rights. The right to a cash dividend out of the company's profits when declared by the company, the right to share in the ultimate benefit flowing from the reinvested earnings, the right to attend the company's annual general meeting, ask questions and vote on resolutions, the right to elect the board of directors of the company, and the right to share in any proceeds if a company is dissolved. Now let's look at the type of shares that's listed on the stock exchange. The classification of shares. Listed equities can be classified as follows. And here's a couple of classifications. Firstly, we're going to look at ordinary shares. These entitle the shareholder to a proportionate share of the company's profits after the claim of long and short-term creditors, debentures holders, and preference shareholders have been met. They are paid by way of dividends. Ordinary shareholders are the ultimate beneficiaries of the retained profits of a company. However, these shares are more speculative than, for example, preference shares as than ordinary shares are more likely to lose their money if the company becomes insolvent. The prices are therefore likely to fluctuate more than other classes of equity, and higher returns can also be expected. Then you get your ordinary preference share. Shareholders of these shares are entitled to a preference dividend only when such a dividend is declared. Your cumulative preference shares. These entitle the shareholder to a fixed percentage dividend each year. If any year there is no dividends that are paid out, the arrear dividends must be paid out in future years and must be settled before any dividends are paid to ordinary shareholders. It's an attractive to an investor wanting to fix their income and a certain amount of security. Then you get your non-cumulative participating preference shares. The shareholder is entitled to fixed dividends as well as the right to vote on management matters in the company. There is no right to a share of the company's profits or any claim to arrear dividends. Then you get your profit sharing preference shares. Shareholders are entitled to a preference dividend as well as a share in the remaining distributable reserves. Then you get a non-redeemable preference share. In recent years, several banks have issued preference shares. The yield of these shares is linked to the prime rate. For example, 70% of the prime rate. As these are dividends, the return is tax-free in the hands of the recipient. In a period when interest rates are low, these preference shares have become extremely attractive for investors taxed at a very high rate. Consider a trust with money in a fixed deposit, let's say paying 10%, and a tax at, let's say, 40%. A trust does not get the interest exemption available to individuals. The return after tax is 6%. If the yield for a preference share is, let's say, 7%, which is 1% higher for the trust, this is then a 7% tax-free return. Then you get your redeemable preference shares. The holder is entitled to a fixed percentage dividend, cumulative or non-cumulative, which is participating or non-participating. The shares are redeemable by the company at a fixed date in the future and can be redeemed by the company at a discount, at par, or at a premium. Then you get your irredeemable preference share. These shares exist until the company is liquidated. The holder is entitled to a fixed percentage dividend, which may be cumulative or non-cumulative. Then you get your convertible preference shares. These may be converted to ordinary shares on or after an option date. The shareholder is entitled to a fixed percentage dividend, cumulative or non-cumulative. In order to exercise the option, the shareholder usually must pay the company an option price. Then you get your deferred shares. These are often awarded to original company founders as remuneration. They are like ordinary shares, but specify that dividends should be paid only after a certain period has elapsed or after a minimum dividend has been paid to an ordinary shareholder. Then you get your debentures. Debentures have become less popular as a way of raising funds since dividends became tax exempt. Distributions paid to the investor from debentures are classed as interest and not dividends. Debentures are debt instruments. They are loans made by a company at a fixed rate of interest repayable on a fixed date in the future. Debentures are often secured over the property of the company. Being a more secure investment, the returns are generally lower than on ordinary loans. Right, and then we just close with this last part on the classification of shares. The ownership of shares is one way in which the individual can share in the wealth of the company. Owners of ordinary shares are the proprietors of the net assets of the company whose shares they own. They participate in the profits of the company by way of dividends after the claim of long and short-term creditors, preference shareholders, and debenture holders have been met. In contrast, holders of debentures and preference shares are creditors of the company receiving a kind of fixed interest from their investment. One of the attractions of dividend income is the way dividends are taxed. They usually tax in the hands of the company, so that's a dividend that's been, the tax has been, they call it dividend withholding tax. The tax has been withheld by the company, and when you get the money paid out, you get it after tax, or some people would call it tax-free, although it's already been taxed by the company. Until recently, dividends received by an individual investor were tax-free in the recipient's hands. Changes have been made whereby the tax will be deducted before the dividend is paid out, as I just explained. As already pointed out, the tax status of the dividend-bearing investment can make them an attractive investment for certain groups of investors. Right, so that concludes our session on equities. The next session, that will be Unit 2.4, we're going to discuss property markets. So see you in the next session. Thank you very much for attending this one.